Hello and welcome to today's video. This is my second video about healthcare companies' earnings, and this time I will be covering latest earnings from UnitedHealthcare as they are leader in this space. So without further ado, let's start. Before we start, disclaimer, nothing here is a financial advice. I'm just one person with a microphone. Always do your own research. First on to operational highlights, UnitedHealthcare reported total revenue of $113 billion for the third quarter, representing a 12% increase year over year. Operating earnings came in at $4.3 billion, reflecting a 50% decline compared to the same period last year, while adjusted EPS stood at $2.92. The company recorded a net margin of 2.1%, a decrease of 390 basis points from the prior year, with a medical care ratio of 90%. UnitedHealth served 50.1 million consumers domestically, an increase of 795K year over year. Its debt-to-capital ratio remains stable at 44.1%. Next, I will cover business segments, starting with core business UnitedHealthcare. So UnitedHealthcare is additionally divided into next segments. First, we have employer/individual, in which revenue reached $19.9 billion compared to $19.8 billion a year earlier. The number of people served domestically increased by 200K year over year, reflecting steady growth in the commercial insurance segment. Next, we have Medicare/retirement segment. Revenue totaled for $43.4 billion, representing a 24% year-over-year increase. The number of people served throughout individual and group Medicare Advantage plans grew by 85K during the third quarter of 2025, highlighting continued expansion in this key segment. And on to the next, community/state segment. Revenue totaled for $23.8 billion, up 18% year over year. Membership declined slightly, with 30,000 fewer members serving during the quarter, reflecting ongoing adjustments across state partnerships and Medicaid programs. As you may get now, we have two main segments, UnitedHealthcare and Optum, where each part has its own segments. When discussing Optum, I will start with Optum Health. So revenue totaled $25.9 billion, remaining flat year over year. Third quarter operating earnings were $255 million, reflecting an operating margin of 1%, down sharply from 8.3% in the same period last year. The decline was primarily driven by continued reimbursement pressure resulting from Medicare funding reductions, along with elevated utilization and rising medical costs. Now on to Optum Insight. Revenue stood at $4.9 billion, also flat compared to last year. Operating earnings from the quarter were $706 million, down from $791 million a year earlier, with an operating margin of 14.4% versus 16% previously. The margin contraction reflects increased investments aimed at supporting long-term growth and expanding the analytics and technology platforms. Lastly, Optum revenue reached $39.7 billion, marking a 16% increase year over year. Operating earnings were $1.5 billion, roughly flat compared to the prior year, with an operating margin of 3.9%, down slightly from 4.5%. The segment continued to benefit from strong script growth and higher consumer engagement, partially offset by pricing and reimbursement headwinds. Caveat to have in mind is total eliminations between business segments amounted to $43 billion, reflecting intercompany transactions that are excluded from consolidated results to present only external revenue. That's why total revenue is only $112 billion, despite Optum and UnitedHealthcare revenue separately would suggest larger number. And now on to some positives. From earnings call, first, margin recovery is expected within the UnitedHealthcare segment in 2026, excluding Medicaid. Optum Health and Optum Insight will take longer to show significant improvement, although moderate progress is still anticipated. Most employer insurance contracts will be repriced for 2026, positioning margins to return to their normal range in 2027. Negotiations with states are expected to establish sustainable premium levels, even if they reduce ACA enrollment by roughly 2/3. This should support margin expansion over time. Now on to quality metrics. So the star ratings continue to improve year over year. For 2026, the company projects that 80% of Optum at-home members will be in the 4-star or higher plans. A net promoter score of 90 plus at top-performing facilities highlights strong member satisfaction and reinforces Optum's reputation for high-quality care. And lastly, on their balance sheet discipline, management has paused both strategic acquisitions and share buybacks to prioritize debt reduction and return to a long-term debt to a capital ratio of around 40%. Now onto some bet takes. Medicare margins are expected to be roughly break-even in 2025 and could decline further in 2026 if cost trend and rate dynamics do not improve. Medicaid margin pressure will persist throughout 2026 with limited relief in sight. And total Medicare Advantage membership is projected to contract by approximately 1 million members next year, temporarily waiting on the revenue. Next, the broader healthcare sector is entering the third year of roughly $50 billion in the industry-wide Medicare reimbursement cuts introduced under the previous administration. These cuts continue to constrain profitability across managed care. Then Optum Health's value-based care membership is expected to decline by about 10% in 2026 before returning to growth in 2027. Lastly, I have some mixed take. So the pause in the share repurchases allow UnitedHealth to dedicate more cash toward debt reduction, which will strengthen the company's financial position and credit profile. However, from an investor standpoint, it also represents a missed opportunity. The stock is currently trading at an attractive valuation, and many institutional funds and long-term investors are actively accumulating shares in this range. In short, it is positive that management is improving balance sheet health, but unfortunate timing to halt buybacks while the stock remains fundamentally undervalued. Once leverage targets are met, buybacks and strategic acquisitions will again become a capital priority. And now on technical side, from its July lows, UnitedHealthcare staged an impressive rebound, climbing from $240 to $380 before entering its current consolidation phase between $310 and $320. The magnitude of the earlier sell-off is best illustrated by May's price action when the stock became so oversold that it dropped beyond its third standard deviation on the weekly chart. By October, it had reached extended levels according to the weekly Bollinger Band, so the current price relief comes as a no surprise. The next step is to see whether the stock can establish a higher low and find a positive catalyst that would support a renewed move toward the $400 level. And my overall take is that the earnings call reinforced that UnitedHealth is in stabilization phase following several challenging quarters marked by policy cuts and elevated medical costs. The company's consistent service quality and strong patient satisfaction metrics remain a key strength and provide confidence in the long-term recovery trajectory. And that said, 2025 and 2026 are likely to remain transition years defined by margin compression in Medicare and Medicaid and modest membership declines before normalization in 2027. Okay, this is it. If you want a full written version, check my Substack. Also, for daily updates and market insights, you can check my X account, and for more educational content, check my website. Links will be in the description of this video, and this is it for this video. Like, subscribe as a sign of support, and see you in the next video. Bye.